The 30-year US Treasury yield just hit 5.2%. That is a 19-year high, the highest level since 2007. If you own Singapore REITs, global ETFs, or have a home loan, this is not just a US story. It is already affecting your portfolio. This video explains what is happening, which Singapore investors are hit hardest, and what you should do about it. Start with the most important question. Why are yields rising? Not because the US economy is booming, but because bond investors are losing trust in US fiscal policy. This is what economists call bad yield, driven by fiscal fear, not growth optimism. The US One Big Beautiful Bill is projected to add $3.4 to $5.1 trillion to the federal deficit over the next decade. US national debt interest payments have now hit $1.05 trillion per year, surpassing the entire defense budget for the first time in peacetime history. America is now spending more on debt interest than on its military. The US deficit is projected to reach 134% of GDP by 2035, up from 98% in 2024. Moody's, the last major agency still holding the US at its top credit rating, stripped that rating in May 2025. For the first time in history, all three major agencies have now downgraded the US below AAA. Traders are now pricing in zero rate cuts for the rest of 2026, and a rate hike is increasingly likely. The bond market is responding exactly as it did when the UK blew up its budget in 2022, demanding higher yields as the price of financing an unreliable borrower. Five groups of Singapore investors are directly in the path of rising yields, and the impact on each is very different. First, S-REIT holders. Singapore REITs dropped 7% in March this year as rate expectations climbed. The logic is simple. When the risk-free rate rises, investors demand higher yields from riskier assets. But here is the nuance. Singapore REIT forward yields currently stand at 5.74%, a spread of 3.7% above the Singapore 10-year government bond rate of 2.04%. Historically, that spread has still rewarded long-term income investors. If you hold quality REITs with manageable debt and locked-in financing, this is a headwind, not necessarily a reason to sell. Second, and this is the single most important insight in this video, cash savers. Singapore T-bill yields have fallen to just 1.4%. They peaked at 4.4% in 2022. Why? Singapore's monetary policy works through the exchange rate, not interest rates. Our local savings rates have not followed US yields higher. While US 30-year bonds yield 5.2%, your Singapore T-bill yields 1.4%. That gap will not close overnight. Third, anyone tempted to buy US Treasury ETFs for that 4 to 5% yield. The maths can work, but only if you account for the US dollar to Singapore dollar exchange rate. If the Singapore dollar strengthens against the US dollar, your Singapore dollar equivalent return shrinks significantly. Fourth, global equity investors. Higher bond yields raise the discount rate used to value future company earnings. Even if earnings stay strong, valuations can compress when the discount rate rises. Fifth, mortgage holders. Singapore's ORA-linked mortgages have not spiked the way US rates have, but the global high-rate environment keeps refinancing costs elevated. Anyone whose loan reprices in the next 12 to 18 months should be paying attention. 5 specific steps. Start with the one that applies to you. 1. REIT holders, do not panic sell. Audit your holdings. Check your REIT's gearing ratio and when its debt matures. REITs with low gearing and long-dated debt already locked in at pre-hike rates are in a far stronger position than those facing near-term refinancing at today's rates. 2. Cash savers, shift idle cash to the best available Singapore rates now. Banks are offering up to 2.90% on fixed deposits. The Singapore Savings Bond, SSB, June 2026 issue, offers a 10-year average yield of 2.11%. With local rates this low, locking in 2.5 to 3% in Singapore dollars is a reasonable defensive move. 3. Before chasing US Treasury ETF yields, check what the Singapore dollar has done against the US dollar over the past 2 years. Factor that currency movement into your expected return before committing capital. 4. Long-term equity investors, stay diversified and do not overreact. The S&P 500 is still up almost 28% over the past year. Rising yields are a headwind on valuations, not a wall against long-term compounding. Focus on your 10-year horizon, not the next 10 weeks. 5. If you have a home loan repricing in the next 12 to 18 months, model a fixed-rate option now. Get the quote before the window closes. So, which of these hits closest to home for you? Are you an S-REIT holder watching your portfolio dip? A cash saver frustrated that Singapore rates have not followed US yields? Someone wondering whether to fix your mortgage? Or a global equity investor trying to make sense of what this means for your funds? Drop it in the comments below. I read every single one, and I will see you in the next video.